Hello friends, welcome to one more video on CVP analysis under cost and management accounting. Under this I am going to explain how to decide about accepting an order from the export or foreign country. Okay, while accepting the foreign offer from the foreign country or any foreign customer, we have to think well before accepting or rejecting it, because some of the orders are not always profitable. We have to calculate the profitability of the order, especially in terms of the profitability before accepting it and after accepting what we are going to earn the profit. So that calculation has to be done before accepting the order. So let's go ahead. So export order refers to an additional or large order received from any foreign customer or a company at a price which is lower than the normal domestic price. Normally normally you will receive the orders in this format. The price what you are selling in the domestic market and the offer price given by the exporting by the company or the foreign company is comparatively low. The price is comparatively low. So that has to be considered. And then when a company is working at a working below 100% capacity and an export order is received at a price which is below the normal domestic price, so such order should be accepted as long as the above variable cost and makes a contribution. So it is above the variable cost and it makes contribution. For example, you should see whether you have additional capacity. For example, a company is having capacity of maximum 10,000 units and at present it is operating at 9,500 units. That means the company is producing 9,500 units per annum to meet the domestic demand. And if a company receives another another demand or another requisite for the production of 5,000 units, there is no capacity, right? There is no capacity. We can maximum produce only up to 500 units. So you should see whether you have the capacity to accept the foreign offer. So if you have the capacity, and even if the price is below the normal domestic price, you should see whether this proposal or the offer gives us the contribution. Okay, gives us the contribution. So whether there is a positive contribution after accepting the offer or order. Okay, we do not worry about the fixed cost here, because fixed cost otherwise also we will incur in the domestic market or to meet the demand of the domestic market. We have to worry about only the variable cost. Okay, because the price is however is lesser than the domestic market, so we have to worry about the variable cost. So you have to deduct variable cost from the sales so that you will get the contribution, right? So if the contribution is positive, then you can go ahead and accept the export order or foreign offer, and if the contribution is negative, you can reject the foreign offer. Okay, so that has to be considered here. So in cases the entire amount of the contribution is profit, because as I already told, fixed cost is already covered in the domestic sales. So you have to worry about the variable cost only and how this foreign offer or export order impacts the contribution. So that has to be considered here. So let us see one example here. So you have this problem or case in front of you. Okay, so this is let me read it. Eye Specialists Limited are famous for specified manufacture of quality eyewears. Presently the company's normal capacity is 10,000 units per month. So that is a normal capacity. Company can produce maximum 10,000 units. But the company sells eyewears in the domestic market at rupees 1,500 units per unit. During August 2022, 6,000 units were sold, which is the regular sales volume for each month all through the year. That means though the capacity is 10,000 units per month, the company is operating at a 60% level. That means it is operating, or it is producing and selling only 6,000 units. Okay, only 6,000 units. Now the cost of production details are as follows: direct material, labor, factory overheads and selling and distribution overheads are given. 2 items are given in terms of per unit and 2 items are in total. Okay, then the company has received an export order for the supply of 2,000 units at rupees 1,000 per unit only. In the domestic market it is selling at rupees 1,500, but this offer is for 1,000 per unit only. The cost analysis indicated that the cost of direct material and direct labor are to be incurred on the export order would be the same amount per unit as the regular one of production. That means the variable cost like direct material and direct labor, that will be same, per unit will be same, 600 and 400 in both in domestic market as well as in the foreign market. Okay, so that is additional information available to us. And finally, prepare a statement showing the net profit for rupees for 6,000 units in the domestic market and 2,000 units in the foreign market, and a total of 8,000 units. So this is the this is the question or the case asked to you. How to now should we accept this order? You have to suggest the company, should we accept this offer or we have to reject the offer. Okay, so as I said, you have to consider about the variable cost only, and again only variable costs are given to us. Okay, there is no fixed cost available, fixed cost information is available, all these costs are variable costs only. Okay, so you need not worry about the profit, you can just calculate the contribution and you can see whether after accepting the foreign offer the contribution is positive or negative. If the contribution of the foreign offer is negative, then you can reject this offer. Okay, let us go to the solution part of this case. So here is the statement showing the net profit. So I did it separately for domestic market as it is asked in the question, 6,000 units, and the export market 2,000 units and total 8,000 units. Since it is asked separately, I did it separately. Otherwise you can have only one column or 2 columns, domestic market and the total. So I'm interested in calculating the contribution. Sales minus variable cost is the contribution, right? So sales in the domestic market it is 6,000 units and the selling price is 1,500. So when you multiply 6,000 with the 1,500, it will come up to 90 lakhs. Similarly, in the foreign market or the export market, 2,000 units at rupees 1,000. Okay, 1,000 per unit. So it is 20 lakh rupees. Total 1 crore 10 lakh rupees. So less variable costs. So direct material, direct labor. So 600 and 400. So 600 into 6,000, 36 lakhs. And here 600 into 2,000, so it is 12 lakhs. Similarly, direct labor 400 into 6,000, 24 lakhs, and the export market it is 8 lakhs. And these 2 items, as I said, this is total cost of factory overhead. Per unit is not given and no additional information is given, and they have not mentioned whether it is fixed or variable cost. So what we consider is factory overhead is variable cost, and selling and distribution overhead also variable cost. Okay, so what we can do is you can calculate per unit cost. So for example, for 50,000 units for 6,000, 50,000 rupees for 6,000 units. So what is the per unit cost? You can calculate that per unit cost and you can multiply with the 2,000 rupees. So that comes up to 16,667. Okay, and then here also again 20,000 rupees per 6,000 units for total 6,000 units. So how much for per unit? So you can take that per unit and you can multiply with the 2000, so that will come up to 8,333. So once you get all the variable costs, you total it, so it comes up to, in the domestic market, up to 60,75,000, and then in the foreign market it is up to 20,25,000. Okay, and you can take the total of that, and finally calculate the contribution. So in the domestic market it gives up to sales minus variable cost, total of the variable cost. So this is 1 and this is 2. 1 minus 2 will give you the contribution. So here it is 2,92,000, sorry, 29,25,000 is the contribution, 29,25,000. However, after, or if you accept the domestic order, sorry, export order, the contribution is negative. So 20 lakhs minus 20,25,000, so it will be minus 25,000. Okay, so by if you accept this offer, you will have to incur a loss of rupees 25,000. Okay, at rupees 1,000. Okay, 2,000 units at rupees 1,000, you will have to have a loss of 25,000. Okay, so better not to accept this order. So that is the advice you can give to this company with these numbers. Since we are incurring a loss of rupees 25,000, if we accept the export order, better not to accept this export order, because this is giving a negative contribution. Okay, so this is how the problem is solved, or the decision is taken when we receive an export order from any foreign country. So that's all. Thank you. Bye bye.